Welcome everybody to the Merit Accountants podcast. This podcast is entitled Why 3 Accountants Are Better Than 1. I'm Richard Mahoney. I'm a partner at Merit Accountants. I qualified with the ACCA back in 2012. I then founded my own accounting practice, Claris Knight Accountants, which merged with Merit Accountants back in May 2025. I focus on the CFO as a service side, which helps businesses plan, strategize, and ultimately scale.
I'm Mukkarram. I'm also a chartered accountant and an ex-Deloitte. I've also worked as a group financial controller in one of the largest industrial developers in the UK. So I come with an industry background, which helps us focus on businesses and day-to-day ongoing support, including management reporting as well as compliance work. I also look after the audit engagements of the firm, which includes group audits as well as single entity audits. We've got a range of audits within our practice covering different industries such as care homes, charities, e-commerce businesses, and others.
I am Hussein. I'm the managing partner of Merit Accountants. I mainly focus on the tax side of the service, focusing on tax advisory and helping clients save tax and keeping more of what they earn. I've been in practice for 20 years and having worked with many of the top 10 accounting firms, including my work at HMRC, and I ensure that our clients are as tax efficient as possible.
Today, this podcast is very much on the topic of why it's really important to have all 3 of our areas of expertise covered in your business. So from tax efficiency to compliance to forward-thinking planning and strategy. It's very important for businesses if they want to scale and be successful. Hussein, I'll bring you in now because often we find that business owners first start taking the numbers seriously when they have a tax issue.
Yes, that's very true. Most businesses look at their numbers at the end of the year when the accounts are due, and when it's a bit too late, there isn't enough time to bring in any efficiencies within their business. And therefore, the way we help our clients is we build in the tax efficiency and the tax strategies as part of the overall service for the business from day one, rather than looking at it at the end of the year when it's too late to do anything.
Absolutely crucial. And Mukkarram, how important is it to be compliant and to have that your year-end accounts procedure and so on and so forth? Is that something that you can start a business and forget about it for 18 months and say, I'll deal with it later, or is it something that you have to get right from day one?
No, I think you should be on top of that from day one. What often happens is people start their business and the first notice they get from Companies House or HMRC for an accounting deadline is when they think about accounting services, which is not the ideal or the right way to approach the finances of your business, as well as, compliance side. You should be thinking about that from day one, because at the end of the day, finances and accounts, what really matters in a business. You can have a great idea, but if you're not able to execute it financially, then everything goes down the drain.
Absolutely, completely agree. And I think that we're starting to see CFO, especially on the fractional side of things, as a service, as a growing part of the industry, really, which is very much what you were just talking about there, Mukkarram. Very forward-thinking. So the notion that, for example, a business that perhaps doesn't have the budget for a full-time CFO, which, if you want to employ a good one, that's going to be £200,000 per year, plus employer's tax and pension and benefits and everything that goes with that. What accounting firms, or many forward-thinking accounting firms, are offering now is that fractional CFO service for their businesses, which is a much more cost-efficient way of looking at things.
Yeah, no, you're absolutely right, Richard. And I think what builds on from what you've just said is what usually happens is people are just focused on their idea, that they're not looking at the numbers. And that's something you need to look at from day one. So as an example, we have a lot of e-commerce businesses, as you would see, these days. It's quite a popular niche and a popular industry for people who are looking to start out in business. And there are some hidden traps in it. If you're not focused or you don't think them through, you don't really see the underlying problem. For example, in an e-commerce business, once you set it up, you're up and running. It's quite easy to get sales in. You set up an Amazon account, Shopify account. You set up AdWords, and you're going to start getting in revenues, from the week you start. But the underlying problem with that business or that industry is the bottom line, that net profit. If you're not careful, you're going to end up spending a lot in advertising, in importing, in your overhead. So if you're just focused at that top line figure of turnover, you're going to be set to fail from day one.
100%. I was working with a client recently it was actually the tech industry, and it was exactly that the business problem that you focused on there, Mukram, in that it was a growing business. The turnover number looked absolutely fantastic, but what they didn't realise was how profitable are they? Are all their clients profitable? Are some even loss-making? They couldn't make decisions on whether or not to hire. And it comes down from the bookkeeping was being done on accounting software, which can produce a relatively accurate profit and loss account and balance sheet. But that only tells you so much. We did some margin analysis on this particular client and who they thought their biggest client, their customer was, in terms of their profit margin and how good they were for the business. Actually, they weren't making much money from this client at all, and they were neglecting areas of the business that were more profitable. So until you've done that analysis, you've had a good fractional CFO has come in and has looked at the numbers from a holistic point of view, they would have just carried on as they were going and losing money hand over fist.
And if you're not careful, you fall into that trap. And as new business owners, you often don't think of these aspects. It's always good to have a good accounting firm supporting you, having conversations with your accountant. We have these conversations with all our clients when we onboard them. What is it that you need from us? What is it that you're trying to achieve? What are your long-term targets? How we come into play and how different aspects of the business can be supported by the firm. So for example, if clients need support with management reporting, having those monthly or quarterly management accounts, meeting with us, we arrange for that as well. So they're more on top of what's happening in the business in real time. Then of course, as you mentioned, we've got the CFO services as well, where, once you've nailed your profitability and where you want to be when you want to think about the future, strategize, that's where that would come in. And I know that a lot of businesses are more focused on tax savings and how we can be set up in a way that is best positioned on that front. So we then have Hussein, who is a chartered tax advisor. And I know that Hussein has regular meetings with clients before the year end, after the year end. That's the company year end. And then for individual tax year ends as well. So, we can do a bit of tax planning there. So Hussein, it'd be good if you could, discuss a few things that you've encountered in those meetings and what you see repeatedly coming up with clients that could help businesses plan better for tax.
Thanks, Mukkarram. Yes, I do have meetings with clients from time to time. And I have seen this trend where accountants still focus on the traditional strategy of small salary and dividends. However, with the recent changes in the dividend tax rate and the corporation tax rate, the scales are tipping the other way, where a salary would be more beneficial. However, we do need to look at employment allowance, because making use of the employment allowance, which is £10,500 per year, would help directors and shareholders take a bigger salary, which would save corporation tax, make use of their employment allowance, and draw money out more tax efficiently. And this is what we've been doing for many clients now, and it does generate a significant tax saving. We do run through the calculations with clients in the meetings, and they can see the difference and they can see the tax saving that is generated from changing the strategy.
You're right. And I think it's important to point out, in order to achieve this, what traditionally happens is clients worry about accounts after the year end, and they're talking about this with their accountants roughly around 8-9 months after the year end. So in order to achieve this, what Hussein's been talking about, a good balance between salary and dividends, these conversations need to happen before the year end in the tax year. So salary submissions and all of these things can take place within the company's year end. So the important point to highlight is ongoing support from your accountant is key these days, and that's where I think we kind of focus on, Hussein, isn't it?
Yes, absolutely. And it's not just two rates of tax, dividend and corporation tax. Corporation tax itself has 3 rates of tax. There is employment allowance, there is the dividend tax rates, and therefore there are a lot of moving parts to arrive at the most tax efficient strategy. And therefore having a good, knowledgeable firm to handle this for you is very crucial.
Thanks, Hussein. And I think, Richard, what you discussed about forward planning, when we're having those meetings with clients, CFO services, you're kind of looking at those areas and planning them ahead of time and flagging it to clients, right?
Well, absolutely. I mean, the key thing here is being proactive, isn't it, really?
Yeah.
In the sense that I would say a company without good bookkeeping, good financial controls, regular monthly management accounts meetings, and of course, tax efficiency. It's a bit like flying a plane blindfolded in the sense that you just don't know. Having visibility gives you confidence, and with that confidence, you can make decisions which help grow your business, scale, and achieve ultimately what you want to achieve. I just want to touch a little bit further about that sort of proactive point, Hussein, because you had a good example recently with a client that you looked at the sort of employment allowance side of things, and you were able to save them a certain amount of money. How much money was that?
Yes, it was 6.5 grand that we saved the client in tax and national insurance.
But that's just one saving, is it?
That's just one saving. That's per year.
Oh, so they're £6,500 better off every single year now
Yes.
if they hadn't spoken to you?
Yes.
Yes.
correct.
Wow.
Yes.
Yes. And a second example where we had a meeting with a client before the year end, and this highlights why it's so crucial to have meetings before the year end and not 9 months after the year end. Their projected corporation tax was 120 grand, and we brought it down to 60 grand. So half
Wow.
of what it was, and by a few strategies, one of them being pension contributions for the directors and analyzing their sales and cost of sales, looking at the turnover and bringing in accruals in their accounts for income that was generated on projects, whereas the costs were not recorded because suppliers hadn't invoiced the costs, and therefore they just didn't appear in the accounts. And we also looked at deferred income for income that was invoiced in the year, but the services were not provided during the year. And analyzing these few areas of the accounts dropped their tax down to more than half of what it was.
Wow, which is great working capital for the business, enables them to grow, hire more staff, etc., etc.
Yeah.
It's really interesting. From a tax saving point of view, Hussein's examples make total sense. There are only good things to come from receiving advice from him.
And I would also highlight that there are many accountants out there who would claim that they can save tax, but also having a reputable firm of accountants is very crucial. For example, we had a client who received a letter from HMRC because she had sold a property, and HMRC claimed that there was capital gains tax due and a capital gains tax return needed to be submitted. I reviewed the case. I wrote just a few lines to HMRC confirming that I've reviewed the case and there is no capital gains tax due to certain reliefs, and HMRC did not ask for any evidence, and they wrote back to the client to say that following review by Hussein of your CGT matter, we have now closed the inquiry as confirmed by Hussein that there is no capital gains tax due. Having a reputable firm in your corner is very important to be successful in business, to safeguard yourself from any issues or any penalties that can come from HMRC.
Yeah, and I think it's happened a few times with you. We all work closely together, so I've seen it a few times, HMRC coming back, noting that, because Hussein's had a look at the details of the transaction, and they've just concluded based on Hussein's review of what's happened. And that showed the relationship the firm has, and Hussein in particular, with HM Revenue. So Hussein has worked with HMRC as well in the past, so they understand and they know Hussein. And there is a existing relationship with HMRC, which helps us safeguard clients, as Hussein mentioned, and really puts us in the best position to be able to support them in tax inquiries and just making sure everything is going by the books in terms of how things would be looked at from an HMRC point of view.
I'm really interested in this capital gains tax example you gave, Hussein. Just out of interest, how much were HMRC looking to charge the client for capital gains tax?
So the gain that HMRC thought should have been taxed was 600,000. At 24% would be around 140 grand in capital gains tax.
So the client could have ended up paying £140,000 if you hadn't reviewed the case.
Yes.
Hussein, you had another example of a tax saving. Was it to do with group structures you were talking about?
Yes, it was to do with associated companies, and where the companies were considered associated by HMRC because of the common shareholdings. And what that meant was the thresholds that apply for the lower rate of corporation tax, which is a £50,000 threshold, where companies pay 19% corporation tax, that gets divided by the number of associated companies. Also, employment allowance is restricted and only one of the companies can claim that. So that's a big financial loss for companies, because where in this example there were 3 associated companies, and each one of them could potentially claim £10,500 of employment allowance, but they couldn't because of being associated, and also paid higher rate of corporation tax because the thresholds were divided between the companies. We sat down with the client, we restructured the ownership of the companies, and which meant that they could now claim employment allowance in each of the companies. So that is 10,500 per company, and also the corporation tax that they paid was at a much lower rate because each company was then entitled to its own thresholds.
The 50K.
The 50,000 threshold,
Wow.
and that generated a huge amount of savings. And as far as I remember, the corporation tax savings that we generated were between 30 to 40,000 pounds between the companies, in addition to the employment allowance.
I think I've seen you have these conversations when it comes to groups and structuring of businesses. I think it'd be good if you touch base on, when you ring fence your assets and your leases to protect yourself. I think that's quite an important area for businesses and business owners.
Yes, that's absolutely right. Tax saving is one area, but having a group structure with a holding company and subsidiaries is a good way of asset protection, where you would hold your valuable assets like properties or leases in the holding company and not in the trading entity, and this would safeguard your assets. So trading subsidiaries or trading companies are exposed to claims from clients or customers, litigation. There is many kinds of exposure that these companies have, and when there are assets involved in these companies, the assets could be targeted, and therefore having a group structure where the assets are safeguarded into the holding company should be considered. In addition, coming back to our sort of the tax saving point, when there is a group structure, there is group relief where one company is making a loss, and it is not just offsetting the loss against any company's profits. It is to offset the loss in a way where you bring the profits down to below the thresholds across the group. The entities are paying tax at a lower rate, not just blindly offsetting it against one company. This is what I have seen from many other accountants, and we look at it in a way that generates the maximum saving.
The point I think we're all trying to raise here, it's quite important that businesses are regularly speaking with their accountants and don't just turn up at the year end or after the year end, and having those conversations on how the accounting firm can support you. Following on from Hussein's tax example, to be able to be in that position to have those meetings, it's, once you've built that relationship with your accountant and you're having monthly meetings, quarterly management reporting meetings, you can kind of identify the problem beforehand. And once you understand your business, you understand what your numbers are telling you, you're in a much better position to make decisions. And I think that once you're there in terms of ensuring you've secured the present position of your business, you're not going to sink now. Then comes in future planning and strategy, where you go from there. And I think, Richard, that's quite an important area. And I think, you must have some examples.
Well, absolutely, Mukkarram. You're completely right. I mean, most businesses don't plan for the next day or the next month. Most businesses start with a 5 or a 10-year plan, really, or the most successful ones that we work with do. So having an accountant or a fractional CFO working with you, whether that's 1 day a week or 2 days a week, really looking at the business strategy, looking at the business, how it is now, where it was before, but most importantly, where it's going. This is a really, really important process to go through as a business owner.
So when we look into future planning, Richard, I think the key area is cash flow for most businesses. And I think you regularly come across issues around that, don't you?
You're absolutely right, Mukkarram. Cash is king. Sometimes the old sayings are the best ones. You all know that profit is vanity, but cash is sanity. It's absolutely critical for businesses to be managing their cash flow. And for a number of reasons. It could be that the seasonality of the business, for example, a retail, would have higher cash inflows around sort of Christmas or January sales sort of time, but could dip quite considerably in sort of traditionally sort of April, May sort of time. So managing cash is very, very important. And from a business growth point of view, it's tremendously critical. How are we going to finance that next stage of growth? Is it going to be debt? Is it going to be equity? Could it be a mixture of the two? These are all things that a fractional CFO would be looking at on a weekly basis, and really forward planning across a very long period of time, I would say up to sort of 5, maybe even 10 years into the future, really, or whatever it is in line with your business goals.
Yeah, I think it goes hand in hand with regular management reporting meetings with your accountants, where once you've got the forecast, you're then measuring performance against it in real time. So if you've got a budget in place, it's quite important that you are working towards that budget or outperforming it. What you don't want to be ending up in is you budgeted something and it's nowhere near reality. Mm-hmm. Sometimes things are out of your control. It's just, for example, wars, oil prices, and so forth. But a lot of it is still in the business's control. If you plan it right, there is no reason why you shouldn't be meeting your profit targets, your sales targets, and your budget. So I think it's what you said is quite important. And once you've strategized, you need to really measure your performance on a regular basis, weekly, monthly, quarterly. And then I think this then follows into aligning your whole business and the people you work with, your workforce, against these targets. That's why you have then performance measures, bonuses, and so forth to ensure everybody's on the same page.
Yeah, no, absolutely, Mukkarram. And finding that another key role that a fractional CFO plays a big part on is fundraising. So whether that's the seed round of investment or the Series A or even onto the Series B, good fractional CFO can position the business in terms of the numbers, the strategy, and the presentation to the potential investors in the best way possible.
Yeah, you're absolutely right. And I think as new business owners, a lot of times you gain this valuable insight from experience. But if you speak to professionals around you, like accountants and other financial advisors, you can get these key pieces of information right off the bat in the initial stages rather than learning from experiences and mistakes. So as an example, I know that from a lot of e-commerce businesses, when they start off, they're short with cash. And the easiest way to raise funds that I see, business owners use is easy funding from Shopify or Amazon, which is there's no credit checks, so it's quite easy to get that cash. But what business owners don't realize is that loan facility is quite expensive, and it's presented in a way that it doesn't seem too much. But if you look at the numbers quite closely, that loan facility is somewhere between 15 to 25 or sometimes even 33% of the loan value. And to make matters worse, it's not 17 to 33% per annum.
No.
It's the value of the loan. And they decide that facility based on your sales. So they sort of recover that amount within 6 months. So you're paying that big of an interest on something that you're going to pay off quite quickly. And it's put in against your revenue. So you don't even have control of how much you pay. It's deducted right off your revenue. So if you've had these conversations with accountants, your accountant, they can probably advise you, what alternatives there are. So to summarize, what you said is essentially compliance and management reporting, forward planning, CFO services, and tax all combine the recipe for success.
Absolutely, Mukkarram. It's about not looking at your business through one lens. Tax is very important, accounting is very important, and forward planning is very important. And when you've got all three working together, you've got every chance of success. And that's exactly what we do here at Merit Accountants, proactively helping our clients in these three crucial areas. So reach out if what we've spoken about today interests you. We're always happy to talk to business owners and let you know the different ways in which we can help you. But thank you for listening, and we'll see you on the next episode.
Take care.
Thank you.
Bye-bye.
Take care.